Hey everyone, welcome back. Today we're going to have another conversation related to financial freedom, flexibility, and empowerment in your life. I will share right out of the gate that this is a bit of a shift from how most people, I think, view money and the opportunity that money provides. We do think, or we hear commercials saying, have your money work for you. But the way that that's created and shared is inside of sort of the scope or a lens that it's going to be building some asset for retirement, and it's kind of murky in what that actually does or how that works. Um, so instead, I'd like to shift that to sort of you being in the driver's seat, you being the person in control, and sort of you being the person who's driving that future forward for yourself. Um, Specifically in this conversation, we're going to leave this sort of image up in the background so you can just view it any time. It's mostly just a conversational medium, but my preference always is to listen to this in the background, but have it be a focus. So whether you're drifting off to sleep, you want something to be there with you. If you're out walking, it's a great opportunity to sort of stack two good habits. One is around sort of building new um, psychological mindset and physical wellness. But also to maybe if you're driving, it's a great to maintain focus on the road, but just kind of let this flow through you. Now, specifically here in this conversation around money, I want to space set it in a couple of grounded sort of thoughts that might get in your way. First of all, you may be listening to this and you may already sort of be in a debt cycle. The interest in your debt is, something that you're servicing, trying to pay, but there's a recurring sort of growth of that makes it difficult to climb out of. And also, you may be in sort of a situation where you're almost kind of living paycheck to paycheck today, and you're kind of just trying to keep your head above water. If you're in one of those two sort of restricted places, this conversation is still highly available and powerful for you. And I invite you to listen to even the smallest opportunity you can see for yourself inside of it. For other people listening, I think the other thing is obviously the earlier you start, the better. But any day you wait is only accumulating the amount of catch up you have to do in the future years. So, if you're a youngster today, this is a great opportunity to launch some pretty simple habits that can have a huge impact on your future. And if you're older, you can potentially have more disposable income at play to make this make sense and make greater impact sooner. Also, what I'd be talking about through this is the idea of using sort of a robo advisor. You could use a normal sort of, investment advisor, but I think robo advisors is great. Sort of in Canada, we have things like Wealth Simple, for example, where you can easily set up an account and then do deposits right into a managed ETF portfolio. But whatever you do, just try to make it easy for you to make small incremental additions to your portfolio without it being big hits from a transaction perspective. You don't want to charge sort of a $10 fee on a $20 purchase. Now, and instead, you could have the money just go in, and there's like a 0.5% or something annual management fee plus the exchange traded fund fees. But again, the conversation is not getting into the scope of fees. I just wanted to give you the baseline of the activity. But first, it's really a mindset piece. I do believe here, if you can shift your mindset and start taking actions aligned with this mindset, it will create a access to a freedom for yourself, not just physically in the future where you actually have more financial flexibility, but today where you're an empowered consumer. And so the base part of this conversation, now as you can relax and settle in, is the idea that we go through our day-to-day life today thinking by and large that we need to work to earn money. We either feel like we trade our physical labor or we trade our time as a service to earn money. Again, let me say, most people believe today the way They generate money for themselves. Cash flow is through working, either trading physical labor or trading time through a service. That's generally how people believe wealth or money is brought in today. And by and large, that is often the way it needs to start out, but it's not the way it needs to go long term. And I provided a relatively simple sort of walkthrough example of how that can look. Now, we're going to look through a very simple example today, but just imagine being able to scale the example. And today, really, it's just setting this simple habit, a simple shift, simple once a week decision change. But if you were to then make more and more decisions aligned with this, you can accelerate your path to financial freedom. So, the base part of the start is to imagine your own life today. You've got sort of these fixed and variable, you have to have expenses. These might be rent, insurance, mortgage payments, things like that on the fixed side. And then you've got the variable side, which is things like maybe heating and cooling, certain sort of need to have groceries and different things like that. But then you have this huge disposable area where you have fixed sort of expenses, maybe like a Netflix subscription, for example, something that's a nice to have, but it's not a need to have. And then you also have sort of other sort of variable expenses like a monthly coffee expense, where you like to treat yourself to a daily coffee. And if it's fancy enough, that coffee could be, $5. But you feel like you're worth it. It's a nice treat in your day. But on both of those, by and large, they don't really give the utility or joy or satisfaction that you think. See, we still kind of go around making purchases like this day to day that really provide no deep purpose, no long term joy, and no meaningful satisfaction. Often, a lot of these things can be routine and on an autopilot, done subconsciously, and consumed or used before there's really even a presence that it existed. You can see this when people get something silly like a donut or something like that. They can inhale it, or a slice of pizza or a whole pizza. And so there's something probably for you right now through your week. And I want you just to really isolate and think about one, something very small that you kind of make a purchase of once a week. It could be something you make a purchase of once a month. That's like a Netflix or something like that. That is, $20. But also just think of things that you make small day-to-day purchases like that coffee, or maybe it's lunch out, whatever it is. And for now, I want you to consider the idea that you could instead say, you know what, instead of, we'll use coffee as the example, instead of coffee today, I'm not going to spend the $5 on coffee. I'm going to bring my coffee instead. A simple decision, that's it. And now you have $5 in your hand. And now there's something to do with that $5. It's not something now that had to exist out of nowhere. It's something that you were trading for something that was delivering you no immediate real value, and it had zero long-term value. So instead, you could take that $5 and you can invest it. And then since we're in Canada, we're going to talk about the TFSA, tax-free savings account, instead of a managed account. So you have a simple way that you can deposit or invest $5 into your TFSA at the end of the week. Or right when you decide not to buy the coffee. You don't buy the coffee, you're going in the elevator up to the office or something like that. You open the app and you put $5 into your TFSA. Boom, done. Now let's just say you do that once a week. And so $5 a month or $20 a month or $5 a week. Now, let's say then that just equals $240 of your investment a year, $5 a week throughout the course of the year. And I've put on a very, very simple and achievable interest rate or return rate of an average of 6%. And the idea is here that in year one, you put in that $5 a week, you've sort of earned that 6% interest compounding over time, compounding weekly. And so at the end of the year, you've given up all those coffees, 50 coffees, 60 coffees, but you only got $8 in interest. And you say, why the heck would I do that? And that's usually where most people stop. They say, that seems absurd to give up 60 coffees for $8. Why would I do this? And they stop. And they say, I'm not going to keep up this, good, habit. I'm just going to now go back to enjoying my coffees because I deserve them. And, earning $8 doesn't make any difference. Now, I want you to pause it instead of thinking of those sort of $8 um, as the net interest or net return. I want you to think of them as 8 workers, 8 new workers brought into your factory. So you put in 240 workers into your factory, and those 240 workers produced 8 more workers. In the world of robot technology for automation, you could think of those 240 robots built 8 more robots through the year. So now you have 247 or 248 robots working in your factory. And every week you go and put 5 more robots or 5 more workers in that factory, week after week after week after week. And, after each year or throughout the year, there's more and more robots added until eventually in year 12 to 13, between that time, the number of workers you're putting in is still 240 new workers, but the factory is producing 240 plus workers. In this case, in year 13, 270 new workers. You're putting in 240 workers, but now your factory is producing more workers than you're putting in. So even if you stop now putting in new workers, the factory will continue to produce more and more workers every year than you've been putting in for the rest of time, assuming the 6% goes on indefinitely. But if you keep putting in your own sort of 240 workers, eventually, and I want to sort of stop here at that 13 part. You can see in that middle picture, the contributions here is still greater, like the total contributions, the total net contributions, not the annual contributions. The total net contributions in year 13, the blue line, is still greater than the interest. But that's the breakpoint where the interest now is greater than the annual contribution. So at that point, the green line is going to grow faster than the blue line forever and ever and ever. Forever and ever and ever. And so now, as time goes forward and the factory is continuing to produce more and more workers, if you just kept up this same cycle of not drinking that 1 coffee a week and putting that money in and allowing the factory to do its work, by year 21, the factory, the total number of workers from an interest accumulated perspective would actually be greater than the amount that you've put in. Let me say that again. The size of the workforce that the factory has built would actually be greater than all 21 years of your accumulated sort of deposits. The impact of the compounding return would make it that the factory is larger total number of workers than your net contribution over 21 years. And now this factory is producing and growing at a greater and greater compounding rate forever and ever and ever at that 6%. And as that money continues to grow, as you continue to add more workers, you can choose over time to say, you know what, I'm actually going to take those 600 workers out. That'd be $50 a month or 600 through the year. Now, let's say you're putting in 20, but you're actually getting 50 out. But now you can take that 600 workers and you can deploy it to somewhere else in your life. Whereas you were giving sort of that 240 units of effort or 240 workers of your life, now you have 600 units of effort coming out from the factory that you can start deploying in other aspects of your life. Maybe this is what's now covering your interest payments. Maybe this is covering your mortgage. Maybe this is, doing other things, or maybe it's just staying in here and continually accumulate and accumulate and accumulate So you have more growth, more freedom, and more choice as your life continues to progress. I mean, if you were doing this at 20, by 41, in this simple little exercise, you'd be already, running ahead of yourself. And if you were to start taking this small action, you might again decide that you don't want two coffees, you don't want three, you don't want four. In fact, you start just loving making coffee and it becomes like a habit and it becomes a passion. And instead, now you're putting $25 extra a month or a week into this factory production method. And you continue this over time and you get to the point where this is what you want to do with your money. You might say, well, pause for a second. What if I put in five and the market goes down? Now I have a coffee. It was five. I could have had the coffee, but now I put in five and the market it's gone down to three workers. Like, why would I want to do that? Why would I want to do that? And we'll talk more about this in a future video. But you actually would like it to shrink. I mean, look, you're taking $5 and you're turning it into $0 in a coffee. If instead you were taking $5 today and it became $3, in the first month or two, so be it. That would mean each week afterwards, you're actually able to buy more, more production in the factory overall because you're buying, this more shares at that same $5, and you're buying more shares at the same $5 and more shares at the same $5. I share that because everything I can sort of see and sense feels like, today where we are, end of October 2025, feels like we're really charging ahead of ourselves. GDP growth and the overall size of the economy is not paced at the size of the returns in the market. But that's fine. As you start chunking this forward and you're building your factory, there'll be times where you're buying when things are more expensive, you're buying things at more cheap. Right now, you don't really want to hone your focus on buying in at the right time. You just want to start honing your focus on building the workers in the factory so that you have, workers working for you versus you always having to be the source of that effort and that work. Finally, what I want to show here on this other piece is the simplicity of what the TSX has actually done in the long term. Again, I'd rather you think more about conservative returns, and if it outpaces that, all the better. But I want to just share about the accelerated returns that come with even small percentage differences in returns. I'd also say this is one of the reasons why, if you were to sort of purchase an ETF of the TSX 60, you could do that at a much cheaper rate than you would if you were to go to a mutual fund advisor who could charge you, let's say, even 1.5% versus 0.08 or 0.1%. That 1% difference would make like massive difference in your ability to then double and compound your wealth over time. So sharing this just so you have a relative frame of reference. In my example here, it was 6% compounded weekly. That took 12 to 13 years for the split to be sort of where the interest was being the same as the amount being deposited each year. And then year 21, where the total value of the interest was now greater than the total value of the all contributions added up. If instead the return was annualized at 11%, not something that I would be planning for, but it would only take 7 years for the annual interest to get greater than the annual investment being put in, and only 11 and a half years for the total interest to be greater than the total investment. So I share that just because that would be what happened if that's what you did with the money. But that's not really the game that we're playing. Today, the game we're playing is just making small, marginal, better choices and taking those better choices, the actual accumulated small dollar amounts, and investing them into your future factory so that you are not the sole worker in your business and you're actually building a team of workers around you that are giving passive income growth and building up your factory alongside you, so that you can eventually choose how to distribute the results of that work, your work plus your factory's work. Love to hear what you think, and